Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today I want to go through how to buy your first home from square zero to full home ownership. So strap in, folks. Now each state has their own specific first home owner benefits and some are more generous than others. I'm only going to go into what the federal government offers are today, but I'll link in the description a great website I came across, and that's got a lot of detailed information going through how it differs state by state. When it comes to the federal government first home owner incentives, there's only two. They are the FHSSS, or the First Home Super Saver Scheme, and the First Home Guarantee Scheme. This used to be called the FHLDS, or the First Home Loan Deposit Scheme. The First Home Super Saver Scheme is exactly as it sounds. It's using a part of your superannuation balance to pay for the deposit of your home. Now, you can't use all your balance, only additional contributions, and there was a cap on that amount too. Okay, so first things first, only additional contributions. What does this mean? This means that only salary sacrifice amounts and personal concessional or non-concessional contributions can be counted towards your amount that you can draw out of the super for the First Home Super Saver Scheme. On top of that, currently, you can only deposit a maximum of about $15,000 each year to count towards the FHSSS. This means that if you deposit $20,000, only $15,000 counts and the other $5,000 will be left in your normal super balance that you can't withdraw until you meet preservation age and a condition of release. I reckon you're now thinking, okay, I'll put in $15,000 for the next 10 years and I'll pull out $150K. Yeah, that's not going to fly either. So currently the maximum amount that can be considered to be withdrawn as part of the FHSSS is $50,000. So it'll take you 3 years of $15,000 plus a fourth year of $5,000 in order to reach that maximum amount that you can pull back out of super for the scheme. This was actually increased from 1 July 2022. Before that, the maximum you could pull out was $30,000, which was 2 years of contributions equivalent. I guess it shows that the government can see that house prices are getting a bit too high, and a $30,000 deposit gets you nowhere. I mean, even $50,000 isn't getting you very far these days. Okay, so now you know the contribution limits and the withdrawal limits. But what is the actual point of using the scheme? The point of using super to save for your home is to take advantage of the low tax environment. The ATO will let you withdraw deemed earnings. This is a guaranteed return, even if the market doesn't actually perform very well. And this deemed earnings is based on the 90-day bank bill rate. Think of this as basically the same as the RBA cash rate, plus 3%. So if the RBA rate is 4%, then your deemed rate will be around 7%. Now, this is a guaranteed amount that you can pull out of super. The risk with this is that if your super fund only performs at 6%, you're essentially drawing down on your other contributions to super, not just those specifically for the scheme. And this can affect your balance of retirement. If your fund overperforms, however, and it goes at 10%, you can only pull out the deemed return and the remaining amount would stay in super. It's important to note that you need to make a determination with the ATO before you sign any contracts to buy. When you make a request for determination, you're asking them how much you can pull out, and you can ask this as many times as you want. You can, however, only request for that money to be withdrawn once, and it must be within 14 days of signing the contract. You can only apply to withdraw the money after signing the contract to purchase, but you need to have made that determination before. If you don't, then you can't access that money. Also note that this is only for people that have never bought property before. You need to be an actual first home buyer. Now, some states allow you to access grants if you've owned an investment property before, and this is your first personal home. But for the super scheme, this needs to be your first property purchase, full stop. The first home guarantee it's very different to the first home super saver scheme. So the first home super saver scheme is about helping you build up your deposit, whereas the guarantee is about helping you not need one, at least not as big a one. Generally, when you buy a property, you should be putting down a minimum of a 20% deposit. So if you're buying something for, say, $500,000, that's a $100,000 deposit. If it's $1 million, that's a $200,000 deposit. Bear in mind that the deposit excludes all other closing costs associated with the purchase, such as stamp duty and conveyancer fees. If you don't have a 20% deposit, most banks will then bring in something called LMI, that's Lender's Mortgage Insurance, and it will be an additional fee that you need to pay for. So what LMI is it's insurance for the bank that if they need to foreclose on the property and they can't get their money back, let's say they lent you $400,000, and then when they sell the property, they can only get $350K for it. They can then claim on that insurance, and that will pay them the difference. So it's insurance for the bank. The insurance company, they'll come after you, but that's a different story for another time. There are some banks that are starting to do an 85% LVR with no LMI. This means instead of needing a $100,000 deposit for $500,000 property, you only need $75,000, and you won't have to deal with LMI. There are two other ways to get a higher LVR. Well, just quickly, I probably assumed you know what I meant when I said LVR. If you don't know what I'm saying, so LVR stands for loan to value ratio. Essentially, how much is the loan as a proportion of the value of the property? The higher the LVR, essentially, the more debt there is. Anyway, back into it. So there are two ways that you can increase the LVR, and they both require something called a guarantor. So a guarantor is normally a family member that will use their own property as collateral on the loan. And that's saying that if you default and the bank doesn't get their money back, they can then come after the guarantor and sell the guarantor's home in order to recoup that money. Now, the bank still only gets their loan amount back, but instead of having the insurance cover it, they have two properties covering that loan. The final way is with the first home guarantee. I reckon you guys thought I was going off a bit of a tangent. No, we're back on track, aren't we? Back on topic. So the first home guarantee, this is the government putting their hand up saying, we will be the guarantor for this loan. If the borrower defaults, come get the money off us. Using the first home guarantee, borrowers are able to borrow up to 95% of the property's value, which is basically the same thing as putting a 5% deposit. So on $500,000, that's a deposit of only $25,000, which is very, very small. The scheme is limited to 35,000 people each year, and it opens at the start of the financial year, being 1 July. There is an income cap though, so singles can't earn more than $125,000 a year, and couples 200 grand. There are a lot of other requirements, so I'll link below a government webpage with more details that you should make sure to check out if you're considering using the scheme. Hopefully I've been able to help you better understand a few different options available for you when it comes to saving your deposit or just getting the government guarantee when you go out searching for your first home. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you guys on the next one.